Hi, I'm Tom Miller, Director of Investment Strategy here at Girard.
I'm Tim Chubb, Chief Investment Officer here at Girard.
Tim, so let's talk about this AI supercycle and what you've termed the boom loop and some of our previous client communications.
Yeah, it's been really it's just the insatiable amount of demand for everything related to AI, including the AI stocks. And so, as a lot of our clients being baby boomers and certainly others have, benefited from the market gains that have been really driven and even, in the second quarter in particular, concentrated, to a large degree within memory stocks and semiconductors. Those gains have been appreciated because ultimately it's, kind of ended up in consumers' pockets and therefore spending. We've seen that demand really, persist on the corporate level as well. This quarter marked a pretty historic one in the sense of we had a huge IPO, largest ever. Somewhat was related to AI growth ambitions there, but another huge component was Google coming out with big equity issuance right before it, and then lots and lots of borrowing on the corporate side, bond issuance, to really fund out this loop. And so kind of seeing, stock prices go up, consumer spending has been, ultimately, I think, supported by, this wealth effect that's been transmitted. And that has gone right back into the economy. And, there's been lots of talk about sort of the circular financing within AI, but to us, that's the one, at least that, kind of matches what we've seen in the market, translating into the consumer.
So it hasn't exactly been a smooth loop though, right? Because we do have bottlenecks in the chain and we're seeing a little bit of that. So there's an insatiable demand for AI, but let's talk a minute on semiconductors and what that means and what is happening with semiconductors right now that we're seeing the returns that we are.
Yeah, it's even, a little bit more narrow than just semiconductors. About 10% of companies have driven most of the returns over this last quarter, about 85, 90% of them. And those businesses have been really squarely within the DRAM or memory complex. Micron, which is based out in Idaho, is really the big US name. Samsung, SK Hynix, and Korea and Taiwan. And so that really drove a lot of the outperformance that we saw within emerging markets during the quarter. But overall, this was a lot of those companies taking price, not necessarily selling more memory chips, but just being able to increase the price in which they're selling them for because of how constrained supply has been in this environment.
But is that sustainable, I think, is the question.
Yeah, well, it's the extent that CapEx is sustainable from a lot of the hyperscalers that, have cloud businesses that are training their own models that are really at the focal, point of really how it gets delivered, right? And so, those companies in the Mag 7 have really driven a lot of the returns over the course of the last several years for the S&P 500. We've had a lot of concentration, not just in the market from a relative market cap standpoint, but also the profit growth. But that spending has resulted in a pretty severe sell-off, I guess, if you will, in those companies. And they were down about 10% during the quarter when the markets had ripped quite a bit higher, about 15% for U.S. equities. So it's sustainable until that CapEx is not. And I think investors, as we go through earnings season for the second quarter, will be increasingly focused on any more revisions higher on the CapEx side. What does 2027 start to look like, and will we have reached peak CapEx growth, not necessarily peak CapEx dollars spent?
And that's the important concept, right? So sustainability, maybe not in growth rates, but sustainable investment theme.
Yeah.
And I think one thing that's underappreciated is the amount of capital that's flowing to AI from both the public and the private sector, correct?
Yeah, absolutely. It's been remarkable. We've now eclipsed the percentage of GDP that's been spent on AI CapEx relative to the railroad build out. And so there is the concern that there'll be overcapacity, there'll be overbuilding that will take place. These hyperscalers do not want to miss out on this next decade and the secular growth theme with AI really eating the world. But at the same time, there are limits and how many dollars ultimately be available. Once you start to take a look at these profit figures, and now a lot of that's being financed not just from cash flow but the balance sheet, and that's where we start to see some signs of, okay, maybe this is going to slow down a little bit.
Yeah, it's pretty remarkable, and hopefully the analogy to the railroad is great. But hopefully the build is a little bit better because I'm still waiting on that high-speed rail from Philadelphia to LA. So,
exactly. I was just going to say, enterprise adoption, really has been picking up. There's been estimates that, about 20% or a fifth of the American workforce has seen that penetration. And I think many companies are still trying to wrestle with who gets access to what is the governance around it, what other AI enabled tools that we already have with a lot of software companies that are going to be able to deliver on AI monetization that I think have been perhaps a bit overlooked by the market.
Yeah, and so just to put it in perspective, and maybe close out here, the semiconductors have really run. We have a Philadelphia-based semiconductor index.
Yeah.
What were the returns this quarter, and what are you thinking for the second half of the year?
Yeah, I think it's a good time to be taking some profits. A lot of these companies have started to lock in long-term contracts with a lot of their customers, essentially guaranteeing some of that new capacity to be taken up over the next couple of years. And so that's healthy. It's also a sign of things starting to get a little long in the tooth in the cycle. But yeah, like you said, our Philadelphia Semiconductor Index was up about 90% during the quarter. Really a historic one that we haven't seen outside the tech bubble. And unlike the tech bubble, the investment that's being made, these are real dollars from biggest companies in the world that are making these investments. It's not pets.com, if you will. And so there's a lot of durability to it, but there's also going to be some cyclicality with it, which is why investors typically have assigned a lower multiple for a lot of these memory stock.
Okay, so maybe some more volatility in the second half. It's not just going to be a one-way trip up for all of these names.
Absolutely. And it's just been pretty fascinating to see the market dynamics of, it's been a one-way trip for a lot of these memory stocks in particular, especially towards the end of the quarter. But anytime those stocks were underperforming the market, it was everybody else that was outperforming. And so I think it just speaks to, the having that longer view and that diversification, not just in, memory stocks.